Hello everyone, Joe Vitale, American Retirement Advisors with the Gradient Investments weekly talking points for the week ending August 19th, 2022. Let's get into stocks. Equities were lower across the globe with the S&P 500 declining 1.16%. The Russell 2000 eased by 2.9 and the NASDAQ was down 2.5%. Now overseas, the developed markets, which is the EFA, were down 2.19 while the emerging markets were down 1.47. Now, within the U.S., the best performing sectors were consumer staples and energy, while communication and materials were the laggards. Large cap stocks did outperform small caps, and value outperformed growth. We talk about that a lot, talking about big companies with dividends and why those are important. Because they're nice buffers, they pay that dividend. It's just, you're going to see the ups and downs in the market, but you're going to see a little bit more consistency. So let's talk about fixed income. Interest rates were mixed last week as the 2-year Treasury remained at 3.25, while the 10-year ended the week up 14 basis points to end at 2.98. Now the yield curve remains inverted, however, as short-term rates remain higher than long-term interest rates. So, they do say with an inverted yield curve that signs of a recession. We are seeing that. We have two quarters of economic decline, regardless of what they say. That's what a recession is. So we are starting to see that. We're going to start to see more of that. That's not the end of the world. We're still going to see ups and downs in the markets. We're still going to see growth. We're still going to see dividends. We're still going to see profits. We're still going to see things moving forward, but we have to see that contraction. So let's talk about commodities. Inflation Reduction Act was signed last week, and energy markets reacted to the news. This bill has multiple provisions for renewable energy, putting the U.S. on a path for 40% emission reduction by 2030. Basically, what this is the climate bill. This is a new Green Deal, part of it. They're saying it's an Inflation Reduction Act. Well, let's be honest, regardless of what they do call it, it's not going to reduce inflation. More spending is going to increase inflation. And even the top economists around the country, many of them are saying the same thing, so that's where we're going with that. They are trying to look for the good things about this, but in all honesty, it's just more spending, and we're going to see it's more of a Green Deal. It's really not going to help much of anything. So, in response to the news, oil prices fell steeply before recovering some of the week's earlier losses to end up at 1.79%. Now, economic data, retail sales were flat in July versus June, but rose 0.7% after excluding volatile gas and auto sales. This was better than consensus expectations for core growth of 0.3%. Also, the June report was restated to show a 0.8% gain over the prior month. Last month, the online retailers were notable gainers, rising 2.7% month over month and 20.2% on a year-over-year basis, while department stores were notable decliners on a month-over-month basis. Let's get into existing home sales. For July, they fell 5.9% from June and were down 20.2% from a year ago. This was the 6th consecutive month of declines, with the western region showing the sharpest declines, and the entire country median existing home sale price they climbed 10.8% from 1 year ago to $403,800, but declined $10,000 from the prior month's record high. We also seeing a softening in the market. You can't raise interest rates on mortgages to 5%. It's just up and down over the 5% mark. But we're starting to see homes that were flying off the shelf. They're actually starting to cool a little bit. We still have demand. We still have low inventory, so we're still seeing sales, but we're starting to see that cool down, and you're going to see more and more of that. Let's go about Home Depot. Let's get some company news. Home Depot, of course, Select, Contrarian, and a G50 holding reported better than anticipated quarterly revenue and earnings than consensus expectations. In fact, the company delivered the highest quarterly sales and earnings in the company history, highlighting the continued strength in home improvement. Shares rose 2.4% for the week. Target, which is of course Select, Contrarian Choice holding, reported quarterly revenue and earnings resulted in consensus expectations. This is despite gaining unit share in all 5 of the core merchandise categories. Comparable store sales grew 2.6%, and digital comparable sales grew 9%, but shares fell 3.15% for the week. How about Walmart? A G50 and Core Select holding reported better than anticipated quarterly revenue and earnings versus the decline that the company told investors to expect just 3 weeks ago. So U.S. comparable store sales grew 6.5%, and e-commerce growth was 12%. Shares were up 3.6% for the week, and that stock is under review in our portfolio. That's it for the week market update. We thank you so much for being a part of our ARA family. If you need to call us, you know the number, 855-756-5700. Visit us at aradvisorsinc.com. Don't forget to visit our Facebook and YouTube pages, like us, and scan the QR code to subscribe to our newsletter if you're not already getting it, or pass it along to somebody. God bless you. That's it for this week. We'll see you.